Viewers at home, you are welcome to my presentation on International Financial Reporting Standards number 15, IFRS 15, Revenue from Contracts with Customers. IFRS 15, Revenue from Contracts with Customers. If this is your first time of coming across my channel, or if you have not subscribed in the past, please hit the red subscribe button and turn on the notification bell icon so that you'll be able to receive notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. IFRS 15, Revenue from Contracts with Customers. Revenue is the income arising in the course of an entity's ordinary activities. An income which arises in the course of an entity's ordinary activities. An income which arises from ordinary activities of the business is said to be the revenue. I repeat, revenue is an income which arises from the ordinary activities of the business. We can have revenue from the sales of goods, where your trading is, where you are into buying and selling of goods. Revenue from trading. And if you are into services or rendering of services such as an auditor, auditors charge fees. Legal practitioner also charge fees. So you can have audit fees. So meaning that fees received from rendering of services is a revenue to those people. So we can have royalty, we can have many other terms which may be used in place of revenue. That is why I said revenue is an income which arises from the ordinary activities of the business. In accordance with IFRS number 15, IFRS 15 identifies 5-step model for revenue recognition. IFRS 15 identify 5 steps or 5-step model for revenue recognition. Number 1 is to identify the contracts with customer. The first step is to identify the contract with customers. Identify the contract with customers. The second step is to identify the separate performance obligations in the contract. Step 2, identify the separate performance obligations in the contract. The first step is to identify the contract with the customers. That is identification of the contract. The second step is to identify the separate performance obligations in the contract. And the third step is to determine the transaction price. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the performance obligations. Allocate the transaction price to the performance obligation. The fifth step is to recognize revenue when a performance obligation is satisfied. So I've told you that in accordance with IFRS 15, in accordance with IFRS 15, the standards identify 5-step model for revenue recognition. The first step is to identify the contract with customers. The second step is to identify separate performance obligation in the contract. And the third step is to determine the transaction price. The fourth step is to allocate the transaction price to the performance obligations. While the fifth step is to recognize revenue when the performance obligation is satisfied. I want to explain each of the steps one after the other. After my explanation, I'm going to apply the 5-step model for revenue recognition in solving an examination question. So, step 1 is to identify the contracts with customers. Identify the contract with customer. That is the first step. So, what is a contract? A contract is the agreement between 2 or more parties. An agreement between 2 or more parties that creates enforceable rights and obligations. An agreement between 2 or more parties that creates enforceable rights and obligations. That is contract. There is no contract if each party has an enforceable right to terminate the contract without penalty. No contract if one or either party or both of the party can just one day stand up or arise to terminate that contract without any penalty. So a contract may be in written form or it may be in oral. It may be oral or written. So I've told you that the first step for revenue recognition in accordance with IFRS 15 is the identification of the contract. That is, identify the contract with customers. I've told you that contract is the agreement between two or more parties. An agreement between two or more parties that creates enforceable rights and obligation. The second step, step 2. Step 2 is to identify the separate performance obligations in the contract. Identify the separate performance obligations in the contract. What do you mean by performance obligations? Performance obligations are promises to transfer distinct goods or services to a customer. Performance obligations are promises to transfer distinct goods or services to a customer. Some contracts may contain more than one performance obligation. After that, performance obligation, I said, is the promise or a promise to transfer distinct goods or services to a customer. When you make a promise to transfer a distinct goods or services to customers, then that is said to be the performance obligation. Step 3, determine the transaction price. That is the third step. That is, determine the transaction price. That is step 3. What do you mean by transaction price? Transaction price is the amount of consideration an entity expects to be entitled to. Amount of consideration an entity expects to be entitled to in exchange for the promised goods or services. The amount of consideration, that is the price, transaction price, that is the consideration an entity expects to be entitled to in exchange for the promised goods or services. That is step 3, to determine the transaction price. Step 4 is to allocate the transaction price to the performance obligations. Step 3 is to determine the transaction price. After you have determined that transaction price, then the fourth step is to allocate that transaction price to the performance obligation. So allocate the transaction price to the performance obligations in the contract. So the transaction price is allocated to each performance obligation in proportion, take note, in proportion to the stand-alone selling price of distinct goods and services promised. I said transaction price will be allocated to each performance obligation in proportion to the stand-alone selling price of distinct goods and services promised. So, then what do you mean by that stand-alone selling price? Remember, I've told you that you allocate it in proportion to the stand-alone selling price of the distinct goods or services. So, what do you mean by stand-alone selling price? A stand-alone selling price is the price at which an entity will sell a promised goods or services separately to a customer. Meaning that where you have more than one performance obligation, maybe one will be sold for $500, another one will be sold for $1,000. So the price at which you will sell a promised goods or services separately to a customer is said to be the standalone selling price. That is, one will be $500, the other one will be $1,000, and not to combine them as $1,500. It's the price you will sell a promised good or service separately to customer is said to be the standalone selling price. That is the fourth step. Remember, the fourth step is to allocate the transaction price to the performance obligation. Remember, the first step is to identify the contract with customer. That is the first thing in revenue recognition. You first of all identify the contract with customer. Then after the identification of contract, you want to ask yourself, is there a contract between this customer and is there a contract between them? That is the first thing you ask yourself. Where contract exists, then you identify the separate performance obligations in the contract. I've told you that the performance obligation, I said, is the promise to transfer goods or services. Is there any promise between them? Is there any agreement between them to transfer the promised goods or to transfer the goods or services between themselves? So when you identify that separate performance obligations in the contract, then the third step is to determine the price. How much is involved? How much is this contract is to be executed? How much is the price in exchange for the goods or services? After the identification of the transaction price, the first step is to allocate that price to the separate performance obligation. Remember, I've told you that the price will be allocated in proportion to the standalone selling price. The fifth step is to recognize revenue. When the performance obligation is satisfied, that is, we recognize revenue when the performance obligation is satisfied. When can you say that the performance obligation is satisfied? Performance obligation is satisfied when the control of the promised goods or service passes to the customers. When the control passes to the customer, then the performance obligation is satisfied. And when the control passes to the customer, then you recognize revenue. At the point where the control of the promised goods passes to the customers, it is then that the revenue will be recognized. So this is the part one. Then I want to solve questions as work example. This question I'm about to solve is taken from Kaplan ACCA study test F7 financial reporting. Kaplan ACCA study test. The question reads, on 1st December 20x1, on 1st December 20x1, Wade receives an order from a customer for a computer as well as 12 months of technical support. Wade receives an order from a customer for a computer as well as 12 months of technical support. Wade delivers the computer and transfer its legal title to the customer on the same day. So this same 1st of December, Wade transfers the legal title to the customer. So since the legal title is passes to customers, since the legal title passes to customers, that means the control of that goods passes on to the customer. So that means revenue can be recognized. So now we want to apply the 5 steps model. The customer paid $420 upfront. $420 upfront. The computer sells for $300 and the technical support sells for $120. How should the 5 step of revenue recognition be applied to this transaction in accordance with IFRS 15? In accordance with IFRS 15, revenue from contract with customer. How should the 5 steps of revenue recognition be applied to this transaction in accordance with IFRS 15, revenue from contract with customer. Now let's have the solution to the question. So in apply 5-step model for revenue recognition, so I've told you that the step 1 is to identify the contract with customers. That is the first step. Step 1 is to identify the contract with customers. So now, if you look at this question, is there any contract you can identify? Remember, I've defined contract as what? An agreement. I said contract is an agreement between 2 or more parties that creates an enforceable rights and obligations. Is there any agreement between 2 parties here? So there is an agreement between Wade and the customers for the sale of computer and the provision of technical support. There is an agreement here that they want to sell computer at the same time to provide 12 months of technical support. So that means there is an agreement. Remember the first step. It says step 1 is to identify the contract with customers. So the step 1 is to identify the contract with customer. Since I've said contract is an agreement between 2 or more parties that creates enforceable rights and obligations. So in the case of this contract now, with the agreement involved now is that there is an agreement between Wade and the customer. There is an agreement between Wade and the customer for the sale of computer and the provision of technical support. So that is the step 1. There is an agreement. There is an agreement between Wade and the customers. Between Wade and the customers and the customer for the sale of computer, for the sale of computers and provision of technical support. And provision of technical support. Provision of technical support. That is the first step. Step 2. I've told you that the second step, after the step 1, step 2 now is to identify the separate performance obligation in the contract. Identify, that is step 2. Identify the separate performance obligations in the contract. I've defined the performance obligations. I've told you that performance obligation is the promise. I said performance obligation, I said is the promise to transfer distinct goods or services to a customer. The promise to transfer distinct goods or services to customers. If that is the performance obligation, I've told you that some contracts may contain more than one performance obligation. There are promises in this question. There are promises. There are 2 promises here. There are 2 promises, that is 2 performance obligations within this contract. The first promise is to supply the computer, while the first one is the supply of computer, while the second one is the provision of technical support. So those are the two promises here. They promise each other that they want to supply each other the computer, and there is the second one to provide the technical support for the computer. So the first promise, there is a promise here: supply of computer, and the second one, provision of technical support. These are the performance obligations in this contract. The first one, the provision, the supply of computer, and the second one is provision of technical support. That is step 2. Then the third step, step 3. Step 3 is to determine the transaction price. The transaction price. Determine the transaction price. Remember, I've told you that transaction price is the amount of consideration an entity expects to be entitled to in exchange for the promised goods or services, or the amount of consideration an entity expects to receive in exchange for the promised goods or services. So if you go back to this question, the total transaction price of the transaction is $420. $420. The customer paid $420 upfront. That is the total transaction price. So, the third step is to determine the transaction price. So, in the case of this contract now, the total transaction price, the total transaction price is $420. That is the third step, the application of the third step. Then step 4. Remember, I've told you that in accordance with IFRS 15, that there are 5 steps model for revenue recognition. I've told you that the first step is to identify the contract with customers, which must be an agreement between the parties involved in that contract. And the second step is to identify the separate performance obligation. I've told you that performance obligation is just the promise to transfer the distinct goods or services between the parties. So when they both agree to transfer the goods, so that agreement, the promise between them, is said to be the performance obligation. The third step is to determine the transaction price, which is the price at which that promised goods should be transferred. The consideration involved is said to be the transaction price. Then the fourth step is to allocate the transaction price to the performance obligations in the contract. Allocate the transaction price to the separate performance obligation, to the performance obligations. Remember, I've told you that the transaction price should be allocated based on the standalone price. You allocate it based on the standalone selling price. I've told you that the standalone selling price is the price at which an entity will sell a promised goods or services separately to customer. So now, if you look at the transaction price in the case of wage contract, now what are their We want to allocate the transaction price to the performance obligation based on the standalone selling price. No, there are two separate performance obligations in step 2, which we have identified. The two performance obligations we have identified in step 2 is, the first one is the supplier of computer. The performance obligation we have identified in step 2, the first one is supply of computer, and the second one is the provision of technical support. Provision of technical support. We now want to allocate the transaction price of $420 identified in step 3. We want to allocate the transaction price of $420 between these two performance obligations. How much will be allocated to the supply of computer, and how much should be allocated to the provision of technical support? So that is what we want to identify. Let's go back to the question. So now the customer pay $420 upfront. The computer sells for $300. The computer sells for $300. Of the $420 paid by the customer, the computer sells for $300. $300 is attributable to the sales of computer, and the technical support sells for $120. So meaning that to allocate that $420, we are going to attribute $300 to the computer, to the supply of computer, and then the $120 to the provision of technical support. So we have computer $300, provision of technical support $120, totaled $420. That is step 4. The allocation of the transaction price to the performance obligations. That is the step 4. The last step, which is step 5. Step 5 is to recognize revenue. When the performance obligation is satisfied, recognize revenue. That is the 5th step. Recognize revenue when a performance obligation is satisfied. That is the 5th step. Recognize revenue when a performance obligation is satisfied. That is the 5th step. I've told you that performance obligation is satisfied when the control of the promised goods passes to the customer. When the control of the promised goods passes to the customer. In case of the wage contract, control over the computer has been passed to the customer, evidenced by the transfer of legal title to the customer on the same day. So the control passes to the customer. That is in the case of computer. You know, there are two promised. There are two performance obligations. The first one is the supply of computer. The second one is the provision of technical support. So the supply of computer, control passes to customers. So the $300 should be recognized as revenue. Control over the computer has been passed to the customer. So the full revenue of $300 should be recognized on 1st of December 20x1. On 1st of December 20x1. But the technical support is provided over time. You know, 12 months of technical support. So 12 months of technical support. As at 1st of December 20x1, you cannot recognize 12 months you cannot recognize the amount paid, which is 120, as revenue in respect of the provision of technical support. The reason is that the time period of settlement has not lapsed, so you cannot recognize $120 as revenue. But how should the 5-step at the end of the year, December 31st, 20x1, how can you apply the 5 steps of revenue recognition to this transaction at the end of the year, December 31st? So remember the provision of technical support, that is to be paid over time, which is 12 months. 12 months of a technical support. So at the end of the year, December 20x1, remember the transaction occurs at January 20x1. As at December 20x1, only 1 month, that is from January 20x1 to December 20x1, which is 1 month of technical support, will have been paid. Since it's to be paid over time, no, it's to be paid monthly over 12 months. So meaning that 1 month will have been paid. Therefore, the amount that can be attributed to the payment of technical support at the end of December 20x1 will be 1 month of that, of the price, which is $120. Therefore, how now we want to recognize, we want to apply the step 5. So apply step 5. Control over the computer has passed to the customer as at 1st December 20x1. Therefore, revenue of $300 will be recognized. On the supply of the computer. The second one is provision of technical support. Remember, the payment in respect of this will be made over time. That is 12 months of technical support. The technical support is provided over time. The technical support is provided over time. Is provided over time. So revenue from this will be recognized over time. It's provided over time. So revenue from this should be recognized over time. In the year ended 31st December 20x1, revenue of $10 should be recognized for the provision of technical support. In the year ended December 31st 20x1, revenue of $10, that is 1 month, from December 1st to December 1st 20x1 to 31st December 20x1, that is just 1 month. That is from December 1st 20x1 to December 31st 20x1, that is just 1 month. That is why we have 1 month times the amount paid for technical support is 120. 1 month out of 12 months in a year times $120, that gives us $10. Should be recognized. For the provision of technical support. Technical support. That is the application of 5 steps model of revenue recognition in accordance with IFRS number 15. Be expecting part 2 to this presentation. So part 2 shall cover other aspects not yet considered in this part 1. Thanks.